Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to test your knowledge regarding the inner workings of both traditional and Roth IRAs using 3 challenge questions. So question number 1 is, how do you handle number 1, a traditional IRA contribution, and number 2, a Roth IRA conversion in the same tax year? Well, first off, why would a scenario like this ever be an issue in the first place? Well, in order to answer that, let's take a look at 2 scenarios that were sent to me by some of your fellow personal tax planning template members. Okay, scenario number 1, Bob goes back to work. So here's the scenario. A couple is retired and doing Roth conversions. So they have a high AGI that puts them above the Roth contribution limit. One spouse decides they want to do some part-time work for fun. And that's going to be Bob right over here going back to the burger shack to flip some burgers and cook up some fries. Okay, now whoa. Just stop right there for a second. What is wrong with that statement made above right off the bat? Okay, let's read it again. A couple is retired and doing Roth conversions, so they have high AGI and that puts them above the Roth contribution limit. What is wrong with that? What is wrong with that statement right there? Well, it looks like it's time for a pop quiz, starting with question number 1 right here. Yes or no? Does high MAGI over a certain dollar threshold cause you not to be able to make Roth IRA contributions at all? And the answer to that one is yes, that is a correct statement. If you have MAGI over a certain dollar threshold, you will not be able to make any Roth IRA contributions. Now, pop quiz question number 2, yes or no? Do Roth conversions count as income when figuring out your MAGI limit for doing Roth IRA contributions? And the answer to that one is no, that is not correct. Roth conversion income does not count as income when calculating your MAGI limit that is being used to determine if you can make a Roth IRA contribution. So no, the answer to that one was no. Now, where can we confirm that information? Well, the answer is IRS Publication 590A Worksheet 2-1. Let's take a look at lines 1 to 3 of the worksheet right over here. So once again, this is Worksheet 2-1, Modified Adjusted Gross Income for Roth IRA Purposes. Right here on line 1, enter your adjusted gross income from Form 1040, line 11A. So we're going to come down here to this sample Form 1040, and we're going to look over here on line 11A. This is our adjusted gross income, and let's just assume for this example it's $310,000. So going back up here, we're going to put $310,000 on line 1 of Worksheet 2-1. Then it says on line 2, enter any income resulting from the conversion of an IRA to a Roth IRA that is included on line 4B of your 1040 tax return. So we're going to hop right back over here to line 4B of this 1040, and we're going to see that there is $300,000 that we are saying for this example relates to a Roth IRA conversion, and therefore we're going to put that $300,000 right here on line 2 of Worksheet 2-1. Then on line 3, subtract line 2 from line 1. So we're going to subtract $300,000 here from $310,000 here, resulting in $10,000 left. Now, there are a couple of other minor adjustments that could be made to the MAGI calculation here, including the deduction that you took for a contribution made to a traditional IRA, the student loan interest deduction, or the foreign earned income exclusion or housing exclusion. But let's just assume that none of those apply for this example, so all we're working with after this subtraction is $10,000. This is your MAGI for Roth IRA contribution purposes. And the takeaway that we want to have right here is that this Roth conversion income of $300,000 does not count for purposes of determining the MAGI that we need to look at for Roth IRA contribution purposes. All right, coming down here to Bob's Burgers once again. So now we know that the first statement of this paragraph is incorrect. However, let's pretend for a moment that somebody makes a mistake about this issue and assumes that because of the Roth conversions and the Roth conversion income, that they can't in fact contribute to a Roth IRA. We know that's not correct, but let's pretend that that's what they assume and they act on that accordingly. So let's see what happens next in the scenario. All right, starting right here, it says one spouse decides they want to do some part-time work for fun. We already talked about that. So they are not eligible to participate in a company retirement program. Okay, I put a green check mark by that. I can agree with that. If you are a part-time employee doing some part-time work, it is highly likely you are not eligible to participate in the company retirement plan. Thus, any money they add to an IRA of any kind has to go into a traditional IRA due to the AGI limits that prevent a direct Roth IRA contribution. I'm putting a red X by this sentence because we already know that that is not the case, but again, we're assuming this person believes it and therefore will act on it. Okay, next, but because they are not eligible for the retirement program, all of their traditional IRA contributions are fully deductible. I'm giving that a green check mark. That is a correct statement. If you are not a participant in a retirement program through your employer, and this also applies to your spouse. So in this case, both people are retired. Neither one of them are eligible for a retirement program at work. Therefore, I agree, no matter what your income is, no matter what your MAGI is, if you are not eligible for a retirement program at work and you make a contribution to a traditional IRA, that contribution is fully deductible, again, regardless of income level. The key to that one is that nobody is covered by a retirement plan at work, so we got a green check mark there. Now the last sentence, since they intend to do a backdoor Roth conversion with those traditional IRA contributions, there is no point in taking the deduction only to have to pay it back during the conversion. Okay, challenge question number 2, is that a true statement? The one underlined in blue right here. This person is basically saying the scenario is that Bob is working part-time. He believes he cannot make a direct contribution to a Roth IRA due to income limits. We know that's not correct, but we're going with the assumption that he believes that and therefore will act on it. So he puts the money into a traditional IRA with the intention of doing a Roth conversion to get the money into the Roth IRA. And since that's his intention, he's wondering if there's any point in taking the deduction for, let's say, $7,000 that he's putting into the traditional IRA. Since he's saying, well, I'll just have to pay that back during the conversion process, so why even bother with the deduction in the first place? The challenge question is that a true statement right there? And I'm going to say let's ponder that for just a moment while we read scenario number 2, which also came from one of your fellow members inside of the Personal Tax Planning Template program. This question comes from a working couple in their 40s. It says, our income is currently beyond the max for a direct Roth IRA contribution. Now note the difference right here. These people are saying that their income, presumably their earned income, because they're not retired, they're still working, they're in their 40s, their earned income is above the MAGI limit to make a direct Roth IRA contribution. That is different than what Bob was saying up here. Bob was saying the reason he believed his MAGI was too high was due to Roth conversion income. So down here in this scenario, this would be the appropriate reason to think you need to do a backdoor Roth IRA, because your income, your earned income, not income from Roth IRA conversions, puts you above the limit to do a direct Roth IRA contribution. So it continues. So every year we backdoor them by contributing the $7,000, etc., to a traditional IRA first, then rolling it over. The correct terminology right here is not rolling it over. They do a Roth IRA conversion. And so challenge question number 3 right here is going to be, what is the best way to reflect this? In other words, how do you reflect a backdoor Roth IRA conversion inside of the personal tax planning template? All Alright, so we have encountered 3 challenge questions so far that need answering. And in order to answer them, we need to go straight to the Form 8606. That's right, you heard me correctly. Form 8606, the form that 61 million Americans with IRAs need to understand, but few of them actually do. So buckle up, my friends, because what you are about to watch is the most comprehensive Form 8606 video ever recorded. Are you ready? Because here we go. Okay, so here's the Form 8606. Let's start with this line right down here, line number 1. It says, enter your non-deductible contributions to traditional IRAs for the current year. And my question to you is, what is the point of doing that? I.e., what is the point of putting a number on this line 1 right here? And the answer is to establish basis. Putting a number on this line is how you establish a record of basis with the IRS. Okay, now what is basis again? Basis is the money you put into something, which you want to have a record of, so that you don't pay tax on the money again when you take the money out of that thing, whatever the thing is that you put the money into. Let's do some examples. You buy a house for $400,000, you sell the house for $600,000. Your gain on the house is $200,000. Are you taxed on the $400,000, which was the original purchase price right here, when that money comes out of, quote unquote, the property? And the answer is no, you're not taxed on the cost or the basis of the property. The basis is the money that you put into the thing. In this case, the thing is a house. And so when you take your money out of the thing, the basis or the after-tax money that you already put in the first place, that is not subject to tax again. The only thing subject to tax is the difference between the selling price and the basis. When it comes to a house, everybody understands the concept of basis. Everybody gets the example that I just stated. Now, what about a stock? Everybody gets this one too. You buy a stock for $1,000, you sell a stock for $3,000. The gain on the stock is $2,000. Are you taxed on the $1,000, the original $1,000, when it comes out of the investment? And once again, the answer to that is no. You put this money in on an after-tax basis. This is your basis in the stock, sometimes called your cost basis. You don't get taxed again on basis when it comes out of the stock position. You only get taxed on the gain. Everybody understands this example as well. When it comes to the house and it comes to the stock, everybody gets cost basis. Now, when it comes to your traditional IRA, if you put $7,000 in after tax, and by the way, how do they know if it's after tax or not? Well, it's after tax if you don't take a deduction for contributing it. That's what Bob was asking about up here in challenge question number 2. Since they intend to basically convert it over to a Roth anyway, Bob is saying there's no point in taking the deduction only to have to pay it back during the conversion. If there's no point to taking the deduction and Bob does not take the deduction, then what is he contributing to the traditional IRA? And the answer is after-tax dollars. The dollars are after tax if you don't take a deduction. So again, coming back here now to the traditional IRA vehicle, if you put $7,000 in after tax and then later you take out $7,000, are you taxed on this $7,000 again? And the answer is no. Why is the answer no? Because this $7,000 is basis. When you contribute after-tax money to a traditional IRA or a Roth IRA, that $7,000 is considered basis. Everybody gets that when it comes to a Roth IRA. You put the money in after tax, you have $7,000 of basis in your Roth IRA. The concept is no different with a traditional IRA. If you put the money in after tax, then you have basis in your traditional IRA of $7,000 in this example. So one more time, just to summarize, if you put the money in after tax, then you have basis in the traditional IRA, meaning you won't be taxed again on that portion of the money, i.e. the portion of the distribution that is basis, when it comes out, quote unquote, of the traditional IRA. However, putting money into a traditional IRA after tax is not the typical, quote unquote, way, is it? What is the typical way? Well, it's to put money into a traditional IRA on a pre-tax basis, which means taking a deduction for the amount of the contribution. If you put the money in pre-tax, then you do not have basis in the traditional IRA, meaning you will be taxed on the money when it comes out of the traditional IRA. Now let's read the blue underlined sentence from challenge question number 2 one more time. Since they intend to do a Roth IRA conversion with those traditional IRA contributions, there's no point in taking a deduction only to have to pay it back during the conversion. When you hear that question, does it sound like 6 of one, half a dozen of the other? In other words, either you put $7,000 into a traditional IRA and deduct it. So let's say that's a $7,000 contribution at a 24% marginal tax rate. The resulting tax savings on that contribution would be $1,680. In this situation, because you deducted it, you have no basis in the contribution. So then when you convert it over to Roth, you're going to pay tax. So that's the same $7,000 multiplied by the same 24% marginal rate results in $1,680 of tax cost. Therefore, the net tax effect of doing this is $1,680 of savings plus $1,680 of cost equals $0 net tax effect. On the other hand, let's say you put the $7,000 into the traditional IRA and you don't deduct it. If you don't deduct it, then you have tax savings equal to 0 on that contribution. You also now have $7,000 of basis because, again, when you put after-tax money into an IRA, you create basis. So now when you do the conversion over to Roth, you don't pay any tax. The tax cost is 0. And so the ultimate result here is $0 of savings plus $0 of tax cost equals a net tax effect of 0, which, by the way, is the same net tax effect we identified over here. And this is what Bob's question is. Are these 6 of one and half a dozen of the other, since the resulting net tax effect appears to be the same? Okay, if you answered yes to that question, i.e. you agree, it does in fact sound like 6 of one and half a dozen of the other, then boy oh boy do I have some news for you. You are half right. Generally speaking, you are half right. But why are you wrong in this particular fact pattern? And the answer is because of the Pro-Rata Rule, which I'm sure that many of you have heard of, combined with the fact that it's implied in the problem that this couple has a large pre-tax balance sitting in their traditional IRA. Okay, wait, where is that implied? It's implied right down here in the first sentence where it says the couple is retired and doing Roth conversions. A retired couple doing Roth conversions means that 99.99% of the time, most if not all of their traditional IRA balance is going to be a pre-tax balance. Therefore, if they have a pre-tax balance in their traditional IRA, and right here they are making contributions to a traditional IRA for which they are not taking a deduction, meaning that they are after tax, then we have to apply the pro-rata rule to distributions from that traditional IRA, whether those distributions are regular distributions or Roth conversions. So with that in mind, let's keep going on the Form 8606 to see what happens, and let's also assume the following amounts for purposes of this example. So our fact pattern will be that Bob contributed $7,000 of after-tax money, and remember it's after tax because he's saying, well, there's no point in deducting it. So he contributes that after-tax money to the couple's traditional IRA in 2025 because, item A, he had earned income from his job flipping burgers, which allows an IRA contribution in the first place. Remember, you have to have earned income at least up to the amount of the IRA contribution in order to make the IRA contribution at all. And then item B, Bob believed that the couple's regular Roth conversion income from a conversion that was completed earlier in 2025, which we will just assume for this example is $200,000 since no amounts were provided in the problem. And remember that Bob believed that the $200,000 caused the couple's income to be too high to make a direct Roth IRA contribution. An incorrect assumption, but again, we're assuming he believed it, therefore he acted on it. Let's further assume that Bob then did the backdoor Roth conversion he was talking about with the $7,000 during 2025. And then let's finally assume that the fair market value of Bob's traditional IRA at 12/31/2025 was $1.5 million. All right, so we're back on the 8606 on line 1. Bob is going to put his after-tax traditional IRA contributions for the current year. In this case, that's the $7,000 noted above. Now, right here on line 2, enter your total basis in traditional IRAs. So what is that asking for right there? Well, it's asking for the cumulative amount of all of your after-tax contributions up through 12/31 of whatever the prior year was. In this case, the prior year was 2024. So basically, if Bob had made any other after-tax contributions in 2024, 23, 22, or at any time in the past, and also none of that basis had been subsequently distributed to him through various kinds of distributions, whatever the cumulative amount that was left would go on this line number 2. So basically, we're taking all of the amount that was cumulatively there through 12/31/2024. We're adding to that the $7,000 of after-tax that was contributed in 2025. And therefore, if we put a number here, which we'll just assume for simplicity that was just 0, then we would have a grand total after-tax basis as of 12/31/2025 before considering any 2025 distributions on line 3 right here. In this case, we're just going to assume that Bob didn't have any other after-tax contributions in the past. Therefore, his only after-tax contribution was this $7,000. Therefore, line 3 will just be $7,000. All right, now this is just a small nuance. Enter the contributions that are included in line 1. In other words, the part of this $7,000 that was made for 2025, but it was actually made between January 2026 and April 15th, 2026. That's a small nuance which we will deal with when we get over here to the 8606 mega calculator. Right now, let's just assume that that portion was 0 and the total $7,000 was contributed prior to 12/31/2025. So $7,000 from line 3 minus 0 on line 4 gives us $7,000 on line 5. Line 6 is going to be the fair market value of Bob's traditional IRAs at 12/31/2025, which if we scroll back up here, we already established to be $1,589,314 in the fact pattern. So that is what constitutes the amount on line 6. Now, going over to line 7, it says, enter your distributions from traditional IRAs in 2025, but specifically do not include any QCDs, any one-time distributions to fund the HSA. We've talked about these two items a lot inside of the class. And also don't include conversions to a Roth IRA on line 7. So right now we're going to assume no other distributions in this fact pattern other than the Roth conversions, which Bob did in 2025, but none of that goes on this line right here. That all goes on line 8. It says enter the net amount you converted from traditional IRAs to Roth IRAs in 2025 for purposes of Bob's conversions. Remember, we said that he did a $200,000 regular conversion sometime earlier in the year, and then he's also doing his $7,000 backdoor conversion now later in the year. So both of those items are Roth IRA conversions. Therefore, we're going to have a grand total of $207,000 on this line right here. Then we're going to add up line 6, line 7, line 8, and that is what's going to be on line 9. Now, what is the point of doing that? Well, this calculation, the way that it works is the IRS is basically saying we want to know what the fair market value of your IRAs was before you did these distributions and before you did these conversions. Therefore, we're going to take your ending balance as of the last day of the year. We're going to add back any distributions that you made, and we're going to add back any conversions that you did, and we're going to put the grand total right here. Then we're going to calculate a factor right here on line 10. And this is going to be the distribution factor that tells you you how much return of basis you are receiving with every distribution that you make in this particular year. Right here on line 11, it says this is the non-taxable portion of the amount you converted to Roth IRAs. It multiplies line 8 by line 10. Okay, so going back to line 8, that is the grand total of Bob's Roth IRA conversions in 2025. We're going to multiply that number by the factor, and that is going to be $807 is the result, and that represents the amount of our basis that is being returned to us with this distribution right here. How much basis do we have again? Right up here, $7,000 of basis. Of that amount, $807 will be returned to us as part of this distribution. Therefore, $7,000 of basis before the distribution less $807 included as part of the distribution results in $6,193 left over of basis carrying over to the subsequent year. So if we look back up here one more time at line 2, remember it said enter your total basis in IRAs. For 2026, the amount on line 2 is going to be what? Well, it's going to be this number right down here. This is the cumulative amount of basis that Bob has through 12/31/2025. That is what will go on line 2, and then line 1, if he makes any more after-tax contributions in 2026, will be added to the amount on line 2 in 2026, resulting in a basis before distributions here. Note on line 12, this is line 7 multiplied by line 10. On line 7, we had no other kinds of relevant distributions for purposes of this example. Therefore, 0 multiplied by the factor just returns 0. However, if we did have another kind of distribution, let's say there was a $10,000 just plain old regular distribution, that number would also be multiplied by this factor, and some portion of our basis would be returned to us on this line. And then if we come down here to part 2 of the Form 8606, on line 16, it is asking for the total amount of our Roth IRA conversions. We know that number is $207,000 based on what was entered up here on line 8. Then on line 17, it is asking how much of that distribution of $207,000 was a return of your basis. We know that amount is $807, and therefore 16 minus 17 gives us the amount on line 18, which is the taxable amount of the Roth conversion, in this case $206,193. So to summarize, this $206,193, this is the amount of taxable income generated from doing Roth conversions in 2025 if Bob does not deduct the $7,000 traditional IRA contribution that was made. In other words, we have $206,193 of conversion income offset by $0 of IRA deduction, resulting in $206,193 of taxable income. And the next question becomes, okay, but what if Bob does deduct the $7,000 traditional IRA contribution in 2025? Well, if this is the case, then our Form 8606 is going to look pretty simple down here. We have $0 of after-tax contribution on line 1. We have $0 of basis carrying over from the prior year. Therefore, we have $0 of basis. We have $0 of after-tax contribution made between January 1st and April 15th of the subsequent year. Therefore, we have $0 on line 5. The fair market value will stay the same. $0 of other distributions will remain the same. $207,000 of Roth conversions will stay the same. However, because there is no basis in this IRA, then the distribution factor is going to be calculated to be 0. Therefore, all of the other items here are going to be 0. And when we get down here to part 2 regarding the Roth IRA conversions, we have $207,000 of conversion. There was 0 basis at all in the first place. Therefore, there was 0 basis returned to us as part of the distribution. Therefore, the taxable amount of the conversion was $207,000. And so to summarize, if Bob does deduct the $7,000, then the net taxable income generated for 2025 is going to be $207,000 of Roth conversion income, less a $7,000 IRA deduction, resulting in $200,000 of taxable income. Going back up here to the after-tax example, the amount of taxable income in the current year was $206,193. If the deduction is taken, the amount amount of taxable income in the current year is $200,000. Okay, now let's extrapolate those results out over time. And let's also assume that Bob quits his burger job after 2025 and the couple simply continues Roth IRA conversions, i.e. there are no more IRA contributions to deal with for purposes of this extrapolation down here. So in scenario number 1 right here, Bob deducts the $7,000 in the year of contribution. So starting right here in line 1, the gross Roth conversion is $207,000 for the first year, and then we'll just assume $200,000 thereafter. The distribution of basis is 0 because there is no basis since this $7,000 was deducted. Therefore, the taxable Roth conversion is going to be the same every year as the gross Roth conversion. The deductible IRA contribution will be $7,000 in the first year, and then there are no more contributions thereafter. And therefore, the net taxable income in this strategy is going to be the same every year of this example, $200,000 a year, until such time as the couple stops doing conversions or the funds are depleted and everything is in Roth or whatever. Alternatively, right down here, Bob doesn't deduct the $7,000 in the year of contribution. In this situation, the gross Roth conversion is going to be the same every year as it was above, but then in the current year as well as every year thereafter, we're going to have a portion of the distribution which is actually a return of basis. Now, the actual amount of return of basis will vary year to year, in part because the fair market value of your IRAs will change, and that changes the distribution factor. But just conceptually speaking, it would look something like this: $807,000, 807, 807, and that would just continue into perpetuity until all of the basis was ultimately distributed. Okay, then if we subtract the gross Roth conversion less the amount that was a return of basis, we get the taxable Roth conversion. In this case, Bob is not deducting anything for the traditional IRA contribution, so that is 0. And the result down here is our taxable income from this scenario. What I want you to notice is that in the first year, 2025 in this example, if Bob does not deduct the $7,000 traditional IRA contribution, then the taxable income in the first year is going to be higher than the taxable income up here in the situation where Bob does deduct the $7,000. However, for every year thereafter, you will see that the net taxable income from this situation is going to be lower in each and every year than the taxable income up here in the first scenario. And that will continue to be the case into perpetuity, or at least until such time when all of the basis has been distributed. Now, looking down here at this final result for the taxable income difference, the takeaway I want you to have is that the difference goes in one direction in the first year, and then the difference goes in the opposite direction for all subsequent years. And ultimately, after all of the basis has been distributed, the sum of all of these differences right here nets to 0. And therefore, over time, there is no difference at all between deducting or not deducting the contribution to a traditional IRA. Over time, the answer nets to 0. So now you can see why you were half right and half wrong if you thought the scenario above sounded like 6 of one and half a dozen of the other, because it is in fact 6 of one and half a dozen of the other over time. But if your tax planning requires you to generate more or less income in particular years in order to fill your desired bracket, or to control IRMA, or to manage any of the other tax issues that we discuss every day inside of the Personal Tax Planning Template Program, then it is not 6 of one, half a dozen of the other on an annual basis. Your decision to deduct or not deduct that traditional IRA contribution in this fact pattern will impact your taxable income calculations on a year-to-year basis. So now we know the answer to challenge question number 2. There may be a point to deducting that traditional IRA contribution, and there may not be a point to deducting it. It just depends if you're analyzing the situation on a year-by-year basis, or if you're looking at it as a whole over time. By the way, check out some of these reviews that I've recently received. I actually want to hop down here to this one, which I really like. Thank you you, Justin, for creating and sharing the spreadsheet and this optimizer and all of the instructional videos. Here's my favorite part. My husband thought I was crazy trying to figure out our first Roth IRA conversion, but you walked me through it all. And this kind woman, in fact, sent me an actual photograph of her and her husband when she was working on the personal tax planning template. Here it is right down here. You can see she's got her mega nerd shirt on. She's got her calculator. She's watching Number Crunch Nerds on her iPad right over here. She's figuring out all the details of the family's very first Roth IRA conversion using the personal tax planning template. And hubby over here, well, he's gonna go outside and put seeds into the bird feeder. So congratulations to you, the person who sent this in on figuring out your Roth IRA conversion. I am so glad that the personal tax planning template was able to help you out and get it done along the way. Okay, now switching gears, what about challenge question number 3? Remember, this is the one from the working couple in their 40s. It says that they have employment income which is higher than the amount that allows them to make a direct Roth IRA contribution. So they do backdoor Roth conversions every year, and the question is, how do you reflect a situation like that inside of the personal tax planning template? Well, let's head over to the personal tax planning template and figure it out. Okay, so here we are inside of the personal tax planning template. We're going to start right here on IRA entry tab number 1. Remember that everything related to IRAs has to be handled per spouse. So IRA entry tab number 1 is specific to spouse 1. And then when we need to enter data for spouse number 2, we will put that over here in IRA entry tab number 2. Now let's think about the question that was asked by this couple. They want to do a backdoor Roth conversion and they want to present it inside the personal tax planning template. Well, there are 2 components to any Roth conversion, including a backdoor Roth conversion. What are the 2 components? The first one is going to be the contribution itself, like they contributed $7,000 to an IRA, a traditional IRA. And so that's the first thing we have to deal with. That item inside the personal tax planning template is entered on IRA entry tab number 1 for spouse 1, and in section number 2 right here, this is the IRA contribution entry. Assuming that this personal tax planning template belonged to this couple, let's assume that spouse 1 made their $7,000 contribution, so I'm just going to put $7,000 in right there. And then what will happen is, as we scroll further down in the calculator, it will determine based on your income or MAGI, based on whether you or your spouse are covered by a retirement plan at work, it will determine how much, if any amount, of your contribution is deductible. This 2026 column right here, as it is currently set up, is perfect for the couple in question because you can see that the AGI is $330,000 in this example, and the income threshold here for deduction for a married filing joint couple where the spouse making the contribution is covered by a retirement plan at work. Either way, it's $149 if you are covered, or it's $252 if you are not covered but your spouse is covered. But regardless of that situation, they cannot deduct it because the actual MAGI is higher than those thresholds, and therefore the result down here will determine no deduction. All right, now going back up here, just because there is no deduction doesn't change the fact that you put $7,000 into your traditional IRA. So now if we go over here to RCTS tab number 1, this is the Roth conversion tax strategy tab for spouse number 1, and if we go down to 2026, you can see that the contribution of $7,000 has automatically populated right here. And so that completes the first component of the transaction. We have entered the contribution into the personal tax planning template on IRA entry tab number 1. The determination as to whether any of that is deductible was made on IRA entry tab number 1, and the amount that was actually contributed was carried up to Roth conversion tax strategy tab number 1 for inclusion in the balance of spouse 1's traditional IRAs. Okay, now what is the second component of the transaction? Well, it's the conversion itself. Spouse 1 is going to do a $7,000 Roth IRA conversion, and in order to enter a Roth IRA conversion inside of the personal tax planning template, we enter that right here on Roth conversion tax strategy tab number 1, and we're going to do that right here in the tentative Roth conversion column. I'm going to go right here to this cell, which is in the row for 2026, and I'm going to type in a negative $7,000 to do my conversion. Now, based on some other factors which are not relevant to this particular situation, it will do a little calculation and determine what the actual Roth conversion is going to be. In most cases, it will be exactly the same amount as you typed in as your tentative Roth conversion. And so with that amount entered right here, we have a $7,000 decrease to the balance of the couple's traditional IRA. After that $7,000 decrease, two things are going to happen. Number one, if we go over here to the Roth IRA conversion tracker, we're going to see the $7,000 going into the Roth via the conversion. And then the second item is we're going to come over here to our all-new Form 8606 Mega Calculator, and we're going to see the amount of distribution related to Roth IRA conversions show up right here in this cell. And the reason it will show up right here is because 8606 is going to perform the calculation that we just went through earlier in the presentation to determine how much of this $7,000 conversion is going to be a taxable distribution or a non-taxable return of basis. Now let's just look at the numbers that we see right here. If we go down to the bottom, as things are set up right now inside of this particular personal tax planning template, and this one does not belong to the couple that sent me the question about how to present a backdoor Roth conversion inside of the personal tax planning template. These are just other numbers that I have been using for other examples. What do we notice right down here? It says on line 16 that the Roth conversion was $7,000. The non-taxable portion of that Roth conversion was $26,000, and the taxable Roth conversion was $6,974, almost the full amount of the conversion. But wait a minute, I thought this couple was doing a backdoor Roth conversion. They were putting in the $7,000 after tax, and then they were just flipping it over to the Roth IRA via a conversion. Why suddenly is there a taxable Roth conversion equal to almost the entire amount of the conversion? And the answer is because of what we just went through on the Form 8606. This return of basis factor is calculated based on the total after-tax basis that is in there divided by the fair market value. This is why backdoor Roth conversions don't work for a lot of people, because if you have a large fair market value relative to the amount of basis, you're going to get a very small factor with respect to how much basis is being returned to you with each distribution. And therefore, I would suspect that if this couple is doing this on an annual basis, chances are they have most of their retirement value in Roth IRA already, and the balance of their traditional IRA is probably quite small, or perhaps even zero. Perhaps what they do is they just use the traditional IRA for purposes of completing the backdoor Roth transaction, but they actually maintain no other balance inside of the traditional IRA. Therefore, if this personal tax planning template belonged to this couple, my expectation is that the fair market value of the traditional IRAs is going to be something significantly lower, perhaps even zero as of the end of the year. And so by changing that to zero, and also let's assume that if they're doing the backdoor conversion every year, there's not going to be any leftover basis from the prior year, so I'm going to zero that out. By doing those two things, we can go down here and see now that the Roth conversion is $7,000 and the non-taxable Roth conversion is also $7,000, resulting in a taxable Roth conversion of zero, and that is when the backdoor Roth conversion strategy works. And again, I suspect that for this couple, although those details weren't provided, probably they have a zero balance at the end of the year in the traditional, because they're simply using the traditional as a vehicle to put the money in and then convert it over to Roth on an annual basis. However, if that's not the case and they do have a balance in their traditional, then undoing the things that I just changed, putting these formulas right back in here, whatever the fair market value is and whatever the total basis is will have an impact on the amount of that conversion that is taxable and the amount that is non-taxable. All right, so we have now addressed challenge question 3 regarding how to present a backdoor Roth IRA conversion inside of the personal tax planning template. We have also answered challenge question number 1, which was how do you handle a traditional IRA contribution and a Roth IRA conversion in the same year? And the answer is very simple. You just tackle all of the components of the transaction one by one. First, you enter the amount of the contribution into the personal tax planning planning template. Then you enter the amount of the conversion into the personal tax planning template, and you let the all-new 8606 mega calculator figure out what component of the distribution, whether it's a regular distribution or a Roth conversion, is a non-taxable return of basis or is just a taxable distribution. In addition, this thumbnail right here will help you remember that Roth IRA conversion income does not count for purposes of figuring out whether you can make a direct Roth IRA contribution. Just remember it like this: you cannot contribute directly to a Roth IRA if you are rich. But for this purpose, rich means that you have MAGI for the current year over a certain threshold, but that does not include Roth IRA conversion income. Therefore, if this number right here was all from earned income or from any kind of income that is not Roth IRA conversion income, this individual right here would be considered rich and would not be able to make a direct Roth IRA contribution. However, coming over here, if this amount right here was broken out as follows: $567,108 of total income, less $500,000 of Roth conversion income, which leaves only $67,108 of MAGI for Roth IRA contribution purposes, then this person right here, despite having a significantly larger AGI, would not be considered rich for purposes of determining whether they can make a direct Roth IRA contribution. By the way, the all-new Form 8606 Mega Calculator is now integrated with the personal tax planning template and is included with your purchase of the program. In addition, I have just added 4 all-new videos to our major March 2026 update inside the members area for the personal tax planning template program. So if you're already a member, you can simply log in and check out those new training videos and the all-new Form 8606 Mega Calculator at your convenience. And if you're not already a member, lifetime access to the personal tax planning template program is available for purchase at the link in the description below this video. My personal tax planning template program is easily the most comprehensive and accessible individual income tax training program in America. Nowhere else are you going to find a retirement planning model and training program that pulls back the curtain on every calculation, every progression, and every decision, so you always know why you are doing what you're doing. My personal tax planning template program takes the most complex principles of retirement taxation and breaks them down into clear, digestible steps that anyone can follow, regardless of experience level. You can join my personal tax planning template training program with lifetime access for a one-time access fee at the link in the description below this video, and I look forward to seeing you inside the program.